Thank you, everybody, for taking time out of your day here and joining us. This is Noah Rosenblatt of UrbanDigs. This is a panel that Brian Meier from Christie's International has organized. I want to thank you, Brian Meier, Senior Real Estate Advisor at Christie's, for organizing this panel, navigating Manhattan real estate. We got a great attorney. We got a great lender. We got Andrew Luftig, a partner at Chaves Perlowitz, Luftig LLP. Thank you so much for joining us. We got Ami Rosen, private mortgage banker at Wells Fargo Private Bank. Thank you, Ami, for joining us. And this is going to be kind of a no holds barred kind of a thing. So all of your people that are on this call right now, and there's more people coming in, I'm going to be muting you. If you look at the bottom of your Zoom screen, okay, make sure you're on mute, everyone on here. If you look at the bottom of your Zoom screen, we have a chat button. Okay, this is where you guys can ask your questions for any of the panelists that are coming out. I am going to do my best to kind of moderate this and keep an eye on that chat forum. And if I don't get to your question, I'm sorry, but I'll do my best to look at it. So with that said, let's get going. Manhattan real estate, it is a dislocated, tricky market out there. So Brian, we're starting with you. Question number one, you're on the hot seat. Where are we in terms of pricing for this market? I mean, I know there's no volume or anything, but everyone wants to know, are we down 20%? Are we down 25%? I mean, what's going on?
That's a very hard question to answer because pricing is dictated by closings. And right now we don't have any closings. We have almost 0 apartments going into contract. The opinion out there is completely mixed. Mostly sellers are thinking that we're down 5% maybe, and there might be recovery, or there are buyers all over the board thinking we're down 20 to 30%. The first closings, the first wave of signed contracts really going to dictate it. My best guess, and this is merely my opinion, is that we're going to see probably a 10% correction in the luxury market of properties priced over $5 million, and a much less change in value for properties priced below that. We have had 2 signed contracts already this month. Both are below $1 million, and both have had about, I'd say, a 5% correction in what I think they would have been valued only a few months ago.
Gotcha. And like you said, it's going to take, it's going to take 4 or 5 months for us to get price discovery on those trades, right? I mean, because all those deals that are being signed right now, they're not going to close for 3 months, 4 months minimum, probably closer to 5 months, like with everything going on. So we're not going to have that price discovery until August or September. Is that 10%, is that like a median that you're thinking of, or do you see pockets of distress anywhere, or what's your thoughts on that?
No, I mean, it's hard to tell exactly what's going to be hit worse. A lot of people are thinking that the demand for foreign national buyers and buyers in Asia is going to be retracted the most. So those properties like new developments and properties that meet those buyers' needs are going to have the biggest pullback in demand. Also, some people thinking that developers that are in more trouble with their lending might have reason to lower their prices more than an individual on the resale basis. They, of course, can rent out their property, and they might have an option to hold their property a little longer than an investor that's paying layers and layers of debt on the property. And a lot of new development, a lot of developers have already had issues over the last couple of years with delays, either in construction, sales, or lending issues. So a lot of people think that's where a bigger part of the pricing drop is going to be.
Right. Yeah. And I would agree with that. And listen, I did a check, and we've only had about 280 contracts signed in the last 4 weeks. So one thing is for sure, and we usually have over 1,000. One thing is for sure is that this shock, whatever, this dislocation, whatever you want to call it, for however long it lasts, it's going to be a very thinly traded thing. And at the end of the day, we're going to look back at those trades, and there's only going to be a few hundred of them that kind of, I guess, mark the pure fear of Corona. Andrew, you're an attorney. You're on the front lines. You're seeing all this stuff. What are you seeing? What are you seeing with existing contracts? What are you seeing with new contracts?
As far as existing contracts, we're fortunately closing deals, right? Deals are happening. It's a process. I joke around, instead of a closing taking an hour or so, it's taking a day or two, right? To schedule a closing's taking a week or so. They're just so many parties involved, so many moving parts. But as long as the buildings are permitting closings, as long as, the managing agents are on board, we can get deals closed. As far as, I think the recent turn of events really literally within the last week is the renegotiations. The deals that have closed are, most parties want to close. Most parties were eager to close. And the first month or so, I'd say there's a lot less negotiations than I thought there would be. But I think the deals now that are starting to be renegotiated are the ones where the buyers were able to close, but they said, listen, let me sit back. Let me see how things unfold over the next few weeks. And we'll go from there. So, we're definitely seeing, kind of in line with Brian saying, anywhere from 2 to 10%. I think, a lot of it is mindset. The conversations I've been having with other attorneys have been a lot less adversarial than I expected. I think people anticipate this, and it's a common conversation, and you're not really offending anybody. But my theory, and I guess my mindset when I'm speaking with other attorneys and even with my clients, whether they're the buy side or the sell side, it's all about, uncertainty, right? With 9/11, Hurricane Sandy, those events happen and you can kind of snap your fingers and things got back to normal very quickly, right? It was a finite period of time. With this pandemic, it's going to be a transition, right? It's going to be a gradual, entry back into the market. So for buyers, the idea is, listen, I'll close if you give me a discount on the price, and I'll deal with the uncertainty, right? I'll deal with the uncertainty of maybe not moving in for the next few months. The uncertainty of maybe the market going down even further. For the seller, they get the benefit of closing now, while still giving a discounted price, and they don't have to deal with the uncertainty. So I think that's for all the brokers, on listening in, I think it's not an aggressive adversarial approach. I think it's a pragmatic approach. The reality is we're dealing with uncertainty, and isn't it fair, reasonable for the purchaser to get a discount if they take on the uncertainty of the market?
Right.
But I think we're going to see a lot of that more and more. Sellers, listen, there's an unreasonable expectation among buyers and sellers that, buyers think they can just cancel deals. They can't. Sellers think they can just force people, to close, serve time to the essence letters. The courts are closed. You can't compel somebody. It's my opinion and a lot of other attorneys' opinions that, you can't compel somebody to close. You can't compel somebody to do a virtual closing, a virtual walkthrough. The courts are going to be closed for the foreseeable future. And when they reopen, there are going to be emergency, lawsuits happening that affecting, livelihood and minors and stuff of that nature, not real estate transactions. So, pre-corona, 99.9% of our deals do not end up in court. Now, I think it'll be definitely, a different percentage, but not as much as people think. These deals are going to be worked out. They're going to be negotiated. Just as a quick note, I put a link to my firm's website. We have a COVID page now with a lot of, up-to-date information on how we're handling contracts and even rental situations, as well as for all the brokers out there, shareable content that they can, put on their social media. But listen, I think, encouraging the conversation. One thing I'll end with, I think is really important. If you're a seller, I don't see how you can engage in a negotiation unless the buyer is ready to close immediately. Think about it. You negotiate now, the buyer's not ready to close, or even the building may not be ready to close. And 2 months, 3 months down the line, you run the risk of the buyer renegotiating or retrading. So be careful, understand, what you're dealing with. And kind of a segue with our banker, Ami, you have to understand, first please speak to your banker and speak to your attorney before you start negotiating. Why? Because an all cash condo deal, listen, you have all the leverage in the world. You can, pick your poison. But if you're financing, whether it's a condo deal or a co-op, or you're financing 80%, 50%, there's different parameters. A bank may not allow you to get such a huge closing credit, right? It may be more of a stumbling block. So understand your power before you start negotiating. Speak with your professionals so you understand what your abilities are.
Right. No, that's good advice. And it's a good segue to Ami over there, because one thing that I'm hearing from the bankers is you got to watch out for loan commitment expiry. Since these things aren't closing, are those loan commitments expiring? And if so, does that purchaser need to go back and get new documents? And has their financial situation changed? Ami, let's just switch right to you, and we can touch on that. What ways are lenders tightening? I mean, this is kind of like 2009. I know lenders are tightening. So in what ways do you see our lenders tightening? And is there anything that consumers can do to maximize their options out there?
Yeah, so obviously, I'm 42 years old. This is the craziest time I've ever lived through in terms of it's not a terrorist attack or a global, we may call it a recession at the end of the day, but this is a virus that has taken us all and put us in our homes. I mean, I read a report from Goldman Sachs yesterday that discussed people may be leaving city centers, right? Which is scary for a New York market whereby the corporations have realized people can work at home. People are stuck in their apartments in $1 million, 800 square foot apartments when they could be in the suburbs. So there may be some movement out to the suburbs, and real estate values in the suburbs may end up going up because of demand. But from a banking perspective, we at Wells Fargo have definitely tightened up our standards, as have many of my colleagues and I discussed. Loan to values have been lowered. How much leverage you can get on a property, how much money you have to have, maybe with the bank or outside the bank post closing. The bank wants to protect themselves from another 2008, 2009 recession fallout, whereby they have a glut of properties they now own, and there's no equity in any of the properties, and they're going to lose a tremendous amount of money. Big fear I see is new development, where maybe a client put in 10% for a property that they're going to close on in a year. If the market corrects 10, 15, 20%, why not just throw that money out and say, okay, I'm not buying this property? These are all fears in the unknown element of this virus, and when we're getting out and when we can leave our house. That's really the unknown. But banks are definitely tightening up. In terms of expiring commitments, if you have an application date of, let's say, February 1st, before any changes were made, we're going to adhere to the same guidelines as when you applied. It's unfair to say you have to put down more money because we changed our guidelines when you applied on February 1st, regardless of whether you have to update documentation. However, if you apply now, we may say, you know what, you need to put down at least 20%, 30% into the property, depending on the property type, characteristics, et cetera, because we need to have that guardrail in place to know if values decline, we're protected. So that's the main thing. And I know we'll touch on appraisals at some point, but appraisers now are not going into properties, right? So that's another cause of banks lowering their LTVs, raising their LTV restrictions, in that we can't really get into the property and access the property to know really what we're dealing with. So we may have comparable sales, but we have no idea what's inside of the property, except maybe a few pictures from the customer. So
yeah, there's a lot of deflationary elements of what's going on right now, and again, the banks, the same thing happened in 2009.
We and any bank, we don't want to foreclose, so I'll have a customer who says, this is a very unique property I'm dealing with near Lake Placid. It's a 172 acre property and has maybe a 2,000 square foot home on it. And the value was $2.3 million. But the bank is saying this property was on the market for 1,300 days. It's a very unique property, and they're going to look at, and the buyer says, I'll put down 50%. And the bank says, it's a unique property. We may not want to touch it. We're not in the business of owning property and owning homes. We're in the business of lending. So from a customer standpoint, they're saying, but you have 50% equity. If I default, you take the house. We don't want your house. That's not the name of the game. We want a loan that we can earn interest on, that we can bulk up and we can sell in a portfolio and secondary market, whatever it is. We don't want to own your home. And in 2008, we really learned that lesson hard.
Yeah, and that's why I think there are flashes of the 2008, 2009 crisis. I mean, it's just so more widespread. And you look at what the Fed's done; they put so much stimulus in there, and you got people saying, "Oh my God, there's going to be such inflation, hyperinflation." Which there'll be some inflation down the road as a wave behind this, but I think now we're facing massive deflation, and people have to understand banks, when they're facing massive deflation like this, they tighten up, and their books, they're not worth the assets on those books, those mortgage-backed securities. Everything is worth a little bit less, and they just kind of have to crunch down and get their capital ratios back. So it's all kind of a feeding mechanism, and it hits the banks. And that's why there's not going to be much inflation, because banks are not really lending. They're not expanding lending, they're contracting lending during this cycle, however long it lasts for. But yeah, we're going to get back to you, Ami. I got a couple good questions later. Brian, I want to switch over to you. Buyers in the market. how do you deal with these guys? I mean, how do you deal with active buyers that are ready to go, but they can't see anything?
Viewing properties, of course, is a difficulty. Some brokers are doing some very nice virtual tours and 3D renderings of the property. Unfortunately, it's hard to search for those type of properties. I don't see any search engine really optimized. So as a broker, you can just search for properties that are easy to view virtually. So we're doing it the old method, calling up brokers that represent a property that our clients might be interested in, trying to get video, trying to get some sort of information in front of the buyer so they can make a decision whether they really want to see the property or not. And once a buyer that we're working with viewed the property virtually and they know that it's a real option for them, then of course it's very difficult to set up showings. What we've been doing is in vacant apartments, having the doorman let the person in one case, in two cases, had the super give access to the buyer. And in many cases, the owner themselves are escorting or opening the door up for the buyer to view the property. But those showings are only happening after the buyer has made a decision through the virtual tour. Some people are saying to me, well, can't they just offer on the property through a virtual tour? And real estate, especially at the price points that we deal with, it's really hard. You can't hear traffic. You can see the view, but you really can't get a great feel of light. You can't get a good essence of the space without physically being in it. So also the buyers that are out there right now, there's really only two categories of buyers that I'm seeing. It's the buyers with a need, the buyers who want to buy either to take advantage of a little bit of the price correction, or they have to meet a timeline that they have a personal timeline to buy a property. And then the second type of buyer is the opportunist, someone who is thinking that they can save 40 to 50%. And as a broker, I think it's important to focus on who you're working with, making sure they're a real buyer, because it's gonna be hard to broker a deal right now. So you want to deal with someone who's really looking to buy. I think it's very important to make sure that buyer is qualified and not just that they sent you a pre-qual that's 3 to 4 months old, because as Ami was saying, things have changed. And from bankers maybe rushing it through to the programs being changed, you don't want to have your client go to all that effort and then realize that they can't even make a purchase.
Now you make a really good point on the tangible aspect of seeing property. I mean, how many times have we seen a property that the buyer loves online, and this is their fave, and it's in their watch list, and they're viewed it 7 times, and they're demanding to see it right away, and then they go in it, and the first 5 seconds they walk in there, they're like, yeah, this place doesn't work. You know, and there's something about it when you just walk into the property. I always told my clients, you're going to know in the first 10 seconds. You walk into the property, your first 15 seconds, you that feeling that you get that this is the right property, that will hit you right off the bat. You don't really have that right now. So it's tough. But Andrew, I got a question. Andrew, I'm going to parlay this. I've been hearing talk. Could buyers sign a contract today? And again, I need to clarify this. Could buyers sign a contract today and have a contingent upon physically being able to see it once the restrictions get eased?
We can create anything, but that's, it's basically an option, right? It basically gives the buyer a get out of jail free card. So you're locking up the property as a seller. It's not so attractive, right? There's a lot of, inspections aren't common in our city. If you're buying my rule of thumb is a building 10 units and under, or a townhouse, of course, you do an inspection. We don't have inspection contingencies. It's not common in our city.
Right.
The idea is, you can really get out of the deal pretty easily. A lot of, buyers are trying to get creative and say, listen, we're concerned with uncertainty. We want to see the property again. We can't see the property. So give us an out if we want an out in the next month or so. I mean, I think it's just pretty dangerous,
right.
Because you get out of the deal pretty easily.
I guess we're trying to think of anything that could help give buyers a little sense of.
Well, I think the big concept for buyers in today's market is they're getting more protection than they've ever received before, right? In a normal pre-corona world regarding financing, that's like the big, question. You have a mortgage contingency, but if you pre-corona, and this is, taking a step back, if all the brokers online, if you have deals in contract, whether you're on the buy side or the sell side, and the buyer's financing, and everybody's ready to close, the bank is clear to close, the building's ready, and they can actually close, but the buyer says, listen, I want to sit tight, I don't want to close right now, I want to be patient and maybe renegotiate a few months down the line. I'll have more leverage. Why does that buyer need to run to the closing table? Unless they're 100% secure with their own financials, their employment, pre-corona contracts, if the bank gives a commitment but pulls the commitment because of any reason relating to the buyer, then they're going to lose their deposit. They're going to take the risk on that. So I had a school teacher who said, listen, I'm not concerned about my job. I want to close in a few months, fine. But the unemployment is increasing and increasing at, record high. So, speak to your clients, speak to your buyers, and before they start, playing cute and trying to renegotiate, if they need financing, they need to, push for financing. But the new world, we're not only getting, mortgage contingencies, we're also getting full funding contingencies. We talk about incentive. How do you incentivize a purchaser to proceed on a deal in today's environment with uncertainty? They're going to get max protection. So that certainly gives them a comfort, but that doesn't help not seeing the apartment. That's,
Is that the
you can
COVID
only be so
clause?
creative. Go ahead.
Is that the COVID clause you
Well, there's two. So
mentioned?
there's two common, clauses that are unique to today's world. The full funding contingency instead of a mortgage contingency. So essentially the buyer takes no risk on financing from contract signing through closing, whether the bank pulls the loan because of an issue with the bank, the borrower themselves, or the collateral, the building. The COVID concept is, in a normal world, again, pre-corona, takes figure for a financing deal 90 days to close, right? That's a reasonable period of time. The corona provision says, hey, listen, if we're still around in 6 months and we haven't closed, is it reasonable for a buyer to be able to cancel the deal, right? Clearly, if we're not closing transactions, we sign a contract now, we're not closing in 6 months. Unfortunately, we're dealing with something even bigger than we anticipated, right? We all expect to be able to actually, sign contracts and close deals in 6 months, but the buyer wants a comfort level that they're not hung up in this deal, in perpetuity forever. It's actually interesting. On new development deals, we always get, it's a drop dead date, essentially, right? The buyer has the ability to cancel the deal if the seller can't close. Just to give an analogy or a similar situation, on new development deals, we always get this language, not related to a pandemic, but it's even, clear cut that says, hey, if the seller can't deliver clear title in 6 months, in a year, we have the ability to snap our fingers and cancel a deal.
Right. Andrew, have you been dealing with a lot of renegotiations in the last 4 weeks or 5 weeks since this started of existing deals?
The last week, the renegotiations have increased substantially. And I think those are the deals that have been around and the buyers don't need to close, but they have some leverage. They can wait things out. So it's happening more frequently now. I think the first, it's been 6 weeks now. The first few weeks that we were just dealing with the uncomfortable and a lot of, just dealing with the new world and adjusting to it. And then the last month we closed plenty of deals with those people that want to close deals. And now we're seeing, definitely a lot more renegotiations.
Right. And is there any sense for anyone that's listening to this that potentially has a deal that might be affected? I'm talking deals that are in contract. Vadim Stern, if you could mute your phone, that'd be great. Anyway, anyone that with the deal that's accepted, any sense as to what do they got to do to get a deal done?
A new deal?
Like a new, so if it's an existing deal and they're running into a block, and they got a buyer or a seller, obviously a buyer that wants to renegotiate and a seller that's unwilling, and they're sitting there and they're trapped. Any type of idea of what type of deal would get it done? Like, I mean, you're seeing renegotiations. What do they look like?
Anywhere between 2 and 10% for sure. Definitely more so 2 to 5%. But I think communication, I think engaging and getting, if you can sense when a buyer's, being aloof when they're playing possum, right? And listen, it's the elephant in the room. I know everybody's scared to engage in the conversation and bring it up, but it's inevitable, many situations.
Yeah.
So I think, getting the parties to have a conversation and speak and just get things moving. There are plenty of sellers who can be patient, who will say to the buyer, listen, I'm not renegotiating. It's okay if this deal closes in 2-3 months. We'll close at the price. We're in contract. And if you refuse to close, then we'll go after you for your deposit. But that's not the norm. A lot of deals will have some sort of retrading, and I don't think the numbers have to be as crazy as everybody thinks. New development's a different world for sure. I had a phone call with a an attorney on a development, and I thought it was going to be a very aggressive phone call. They pretty much said, make us an offer, and so, now we're going back and forth, and we're just kind of dancing a little bit, and we'll come to a reasonable number, so I think it's just engaging in the conversation, and you'll know pretty quickly if the other party is receptive to it or not.
We had 2 renegotiations on solid deals that didn't have a contingency, and one was a $3 million deal where it was literally $5,000 credit to the buyer. So nothing. The buyer literally wanted to feel they were getting something. I feel, in my opinion, like it was $5,000 seller credit. And the other one was very interesting. It was a smaller deal, and money was put in escrow, and the owner had to cover the mortgage and the maintenance. The building was on lockdown and wasn't allowing move-ins. The owner was covering all costs until the lockdown was over, plus 1 month on top of that, and that's what got that deal closed.
Yeah, I think it's really important. Brian makes a good point. Like, whenever anybody's discussing money, everybody's like heart drops, right? Everything, it's so dramatic, and it's going to be so intense. To Brian's point, it could be something very simple, right? It could be, you listen, buyers have buyer's remorse, right? It's clear. So it doesn't have to mean them getting a huge price reduction. It just be a little carrot, will change your world. So that's why engaging in the conversation and maintaining communication is key. Don't make assumptions. Every deal's different. Every situation is different, especially in today's world. Yeah. So you need to take the time to speak with the other party and kind of also just listen to what they have to say, because they may tell you more than they really mean to tell you. Yeah. And all of a sudden you realize it's not such a bad situation.
I've had those strange calls where you have a customer, a client, and you want to do business, and they're calling me, and I've had multiple calls like this over the last 2 months. How can you decline me, right? As a bank, they want to they have a financing contingency, or they want to get out of the contract, and how can you decline me? I said, sir, you have $10 million in the bank and you have a great paying job with a large bonus at a big Wall Street firm. There's not much I could do unless you lose your job and give away all your money. So, and even that would be quite suspect. So in terms of renegotiating from the banking side, when people want to try to find a loophole to get out of a deal, I've been getting those calls. How do you decline me?
Yeah, that's really interesting, and I guess that's going to happen while we're in this dislocation period. I mean, it's comforting to hear that, look, you got to be receptive, you got to listen, and it sounds to me like, they're not throwing the kitchen sink in for renegotiations. You know what I'm saying? It sounds like it's somewhat reasonable, and it's not a huge pain for the seller, and it's going on. So that's important.
And all that's going to depend on how long this goes on. Like if May 15th becomes June 15th and unemployment goes up another 10%, then those negotiations, once the values have dropped more than their 10% deposit, that's when things get that's when buyers get a little more.
See, I got to be honest with you, Brian. I think anyone that accepted an offer or had a deal verbally accepted to around the mid-March and think 4 weeks ago, when the stock market was at the depths of hell, we've since rallied 25%. The numbers were much scarier. The hospitals didn't have the gear. I mean, over the last 4 weeks, we've gotten some answers. We've gotten some clarity. The numbers have flattened. The stock market's rallied 25%. I feel like the level of fear today, right now, I'm talking about accepted offers.
Yeah, but that's March. There's a lot of deals in contract that went to contract in January and February. You know it better than anyone. We're very busy months for signing contracts, and a lot of those contracts haven't closed.
Right. So now that's a good point. So now that's gonna mean that we're gonna have a couple of good months of sales data to come through the funnel, the pipeline, before this whole Corona hits. That's number one. That's a really good point. But I think
if they close.
Yeah, if they close. Well, that's not going to be for a couple of months. I mean, but the fact is, once they do come in, we do have some upward pressure before the destructive dislocation kind of hits in 4 or 5 months. But I mean, I think whoever accepted an offer in mid-March or the end of March and ultimately signed a deal maybe early April, somewhere around there, you might see some pockets, some extreme outliers, because it was highly dislocated at that time. And that's kind of the environment that's right when you have a really big bid-ask spread and a seller just gap down, hits a low bid, and it's like 20% down or 25% down. It may not define the market, but it might occur and happen in reality in the dislocation. And I think those trades, those kind of peak fear trades, in my opinion, that window is already passed. Like, I think that window already passed. I don't think the market today, it's fearful, it's dislocated, it's down, granted, but I don't think it's as fearful as it was 4 weeks ago for those deals. And there was only probably 100 of them that were signed at the end of the day. Hey, listen, I got to get to Ami. I got a couple questions here. Ami, listen, what's your thoughts on interest rates? I know this is a big question. Deflation versus inflation. Are we going higher? Are we going lower? And any color on appraisers? I know we wanted to get this in. Are appraisers looking at the market? Are they deeming it a declining market yet, or is it to come?
Right. So comparable sales in the area dictate what an appraised value is on a residential mortgage. So comparable sales within a half a mile, within a 6-month period, are going to determine your value. So we haven't seen any appraisals coming in low, strictly because we have the last 6 months and the prices have been regular. We don't have new closings showing any drop in price. So we may see that as August, September, October comes around, and we have some closed sales from June, July that were lower than market. That might have an effect. But again, appraisers can't get into homes right now. So, we're doing drive-by appraisals, and the whole system has kind of changed. But the values have remained intact. And I mean, really in 2008, the landscape changed completely for appraisers, right? As a banker, I used to be able to talk to an appraiser, call them on the phone and talk to them about the property. Then the AMC, the appraisal management company, was instituted, and we have zero contact with appraisers. So appraisers are less likely to worry about giving the quote unquote right value or correct value. They just they can get the deal done, they get paid per appraisal, and they really have no worries. But they do a great job, and they adhere to the comp system within a half a mile within the last 6 months. They rely on building comps in any given building. They adjust on floor levels, et cetera. But we haven't really seen any drop in appraised values as of yet, but that essentially could be an issue. I mean, like in any global recession period or like the period we're going through right now, cash is king, right? So from a lending standpoint, we will lend, we will break the rules, we'll make exceptions for anybody who has money, right? And, if you have a lot of money and you're looking to capitalize, for lack of a better term, on this world pandemic that we're going through, if values drop 20, 25%, in all likelihood, they're going to come back up at least 10, 15%. You would know better than I would know, but, history would dictate as much. And also a lot of, multifamily owners or landlords who aren't getting paid rent right now, right away it was deemed, okay, you got 90 days, don't pay your rent, you're good. We're not coming after you. And they put landlords in a tough spot. It's, why would I pay my rent if I don't have to? So landlords are really getting hurt, which means cash flow is down. They may have a mortgage on their building. They need to pay that mortgage. And there's a free fall happening. So if you have money, you can really pick up some multifamilies that haven't been accessible to trade in that space for a while. You can pick up some multifamilies, you can pick up some larger buildings. So, that's in play. Retail office space could be hurt a little bit given this new digitized world that companies see they can live in, right? Facebook just took out a big lease on new property space. But if you have a 20-person company in Midtown, and you see your company still functioning now, do you realize you don't need that $20,000 a month rent? You guys can work remotely. So that's going to be kind of affected. Just to touch on interest rates real quick, the interest rates are low. I mean, they're historically low. They're not as low as they should be, right? So with the 10-year treasury where it is, with the stock market where it is, with the world in flux, interest rates should be far lower than they are. They're still very low historically, obviously, but banks have kept them at bay, especially on the refinance side. They said, okay, let's stop the flow of new refinance applications. But on the purchase side, they're giving good rates. You have a relationship, you can get good rates. You can get in the low 2s on ARMs, or in the high 2s on a 30-year fix, which, don't get me wrong, are amazing rates. They're not as low as they should be, and that might continue to tick down if we stay down and as the bank gets less applications in the door. But definitely, my one thing, if you have customers, if you have clients who have a lot of money, this is the time, to really take advantage. I think in like a month or two, people are just going to be looking to get out, and you could really buy low. There'll be a lot of opportunities out there for people.
Yeah, and that's a great point, Ami, because listen, if you're going to buy low, you got to buy when there's blood on the streets. You got to buy when no one else is buying. And that's the whole point, is we're in this very highly illiquid, dislocated, very thinly traded market, meaning there's a gap between bid and ask that the seller's coming down to. And just like you said, the sales aren't coming in. So the appraisers are not yet seeing it, which means we could predict the future, Ami.
Yeah.
We all know that sometime in the next 3, 4, 5, or 6 months, we don't know exactly when, but we know it's at a lag. The sales data is going to come, the comps are going to come, it's going to reflect this dislocation, and the numbers are going to be like down 20% or down 15, whatever it is, whatever it happens to be. And then we're going to react. But the thing is, the market at that time might be in a totally different place. We might be in recovery mode at that time in 6 months when that headline hits. And
that's always the story. The data always lag behind reality. I think right now, just to quickly address what a buyer needs to do if they're trying to get some advantage to where the market is right now. Every seller out there is in a different position. A lot of sellers right now haven't felt enough pain and might never feel enough pain to really bring their prices to a point where it's more than 10% below market. So as a buyer, you have to be able to make more than one choice, because the one property you're looking at might not have enough pain to come down to that price. You have to choose 10 properties to find that one that's willing to negotiate where you want it to be. Also, it's most likely the property that's willing to negotiate the lowest down is the one without the video tours. It's the absentee owner that can't get access, or the apartment doesn't look the best, or they're in a position. So a lot of times it's going to be actually harder to get that deal done. It's going to be a hard time to really access those prime deals. And I don't think it's going to be like 2007 or 2008, where there are lots of really juicy deals just lined up.
Right. Now, that's such a great point right now, because buyers think that it's just 25% off everything. And that's just not the case, because how many sellers are hitting that bid? Clearly not a lot, because deal volume, there's only a couple of hundred deals that were signed since this crisis started. And that's not a lot. Listen, this has been fantastic. We're getting towards the end here. Andrew, I haven't heard from you in a few minutes. Do you have any parting words for anyone before buyers, sellers, agents?
Well, I think, buyers, sellers, agents, now is I think the time to start planning, hopefully, for the end of this, right? The back, where you are, where you position yourself on the back end. I think you mentioned it before, Brian did. Our first quarter, or up to this, we were having our busiest year at the firm by far on every end. So New York is certainly a resilient place, right? It's definitely gonna be different than Sandy and 9/11, but there has to be pent up demand. There has to be people ready to go once this is a little bit more relaxed. And what we're experiencing right now is a life event, right? So life events actually lead to activity in the real estate market. There are people, all kidding aside, getting divorced because of this. There's people that are leaving the city, coming to the city. Unfortunately, people that are passing away. That all leads to activity in our market. And listen, we will feel awful if prices come down and our clients lose money. But for real estate professionals, we want activity, right? That's the most important thing, that the market is active. So it's going to happen. And how are you positioning yourself now? There's opportunity. Unfortunately, sometimes it takes something bad to happen to create opportunity. There's a lot of real estate professionals that will almost make their careers or kind of step up their careers during this time, because they're laying the seeds. They're speaking to people they haven't spoken to before. People are more receptive to listening to them now as opposed to, in the past. So there's plenty of opportunity. There's always, the big line these days is a silver lining, right? So, find that and really over the next few weeks, month, whatever it is, start, planting the seeds, and, good things can happen from this. It may take a few months, it may take a year, it may take 2 years, but there's definitely opportunity. Right.
This has been great. Thank you so much, guys. Thank you to everyone for joining in here. I think we're going to have a recording of this, and we'll have blast that out to all of our panelists, and we'll send it so you can listen to it 10 times over. Andrew,
you click the button, maybe.
I clicked it. We're good. We're recording. Yeah. Oh, sorry, guys. I forgot to record it. Oops. Andrew Luftig, thank you so much. Brian Meier, you're the man for organizing this. Thank you so much. And Ami Rosen, thank you guys so much. I am Noah Rosenblatt of UrbanDigs, and I hope you guys have a great day. Stay safe and be well.